to see everybody. Hope everybody's having a good fall so far. Certainly some interesting times. I'm grateful that the election is decided, and I think that's been an overall positive on the market. Whether you're happy with how it went or not, I think there's knowing is better than not knowing, and I think that's been a positive. I do think I'm not going to talk about it today, but I think that recession still is on the table. I think whoever won was going to inherit that either way in the next year to two. There are things that back that up, but I'm not going to talk about that today. Maybe next time, maybe early next year. But I always keep that in mind. But that's down the road at this point. We're going to look through the normal money flow factors that we always look at, how the sectors are acting and all that. And then the markets are actually calming down after being crazy, as expected for the election season. So we're going to dive into that specifically. And then, but first, I'm going to jump through each of the market sectors and show you a huge difference. I thought this was just super fascinating. Since the election was right there, we were right here for the election. At that point, it looked like the market was struggling. And this, had we not had a decided outcome, this very easily could have gone down this much. This was very much an unknown. The trend was very iffy at that point. But we did have some money invested, and this is just the S&P and NASDAQ. Of course, the red is the S&P, the green is the NASDAQ. Now, interestingly, NASDAQ peaked back here in July and just now finally broke back above it right there, right, that price level. But the S&P did not have as big a fall, and it's been grinding its way back, and it went back to positive actually back in September. And even with this iffy spot from the election, it still jumped up pretty well. The U.S. domestic, the main domestic market looked pretty good, and small caps similar, but it's a little messier, it's a little bit all over the place. But then you go to international, we have red is developed, green is emerging. Those are not as good, and they haven't been as good since early October. I think that also backs up with the U.S. dollar has been rising. So this is really an effect of that. Although in one case, we do own a little bit of emerging markets, but the low volatility part, so it's not getting hit this much. But beyond that, we're really avoiding international because it's just that's not the kind of trend line I want to see right there. And then you go into bonds. And back in September, this was where the Fed did the first rate cut. And then right here is where the Fed did the second rate cut. And it's just, the bond market does not seem to like that, which is really the opposite of what I thought would happen, because usually when rates fall, the bond values go up. But that's really not happening, certainly not on the midterm, right? The medium bonds. The short-term rates, sure, it's going that way, but not the longer end. And usually the aggregate is the red. That is like an aggregate of all the bond indexes, just a good broad base. And then the green here, I have the 10-year Treasury, which I really thought would have done better, because that's really a little more tied to that, but they just don't seem to like that. And I know I talk in our newsletters frequently that the bond market has been a terrible diversifier. I mean, they had a great run here, from June to September, but you go back before that, it's just been a grind down. And I think the 3-year numbers of both of these are negative 2%, somewhere in that range. So it's not helping by owning bonds. Now, that's the traditional bonds. There's some great stuff in the short term. There's high yield bonds are doing actually pretty well, as are floating rates. And that's really anytime that we own a bond or something more safe, those are the categories that we own. And those don't look anything like this at all. They're just a steady, boring line up, which I'd much prefer, because this volatility is just crazy. But at some point, I really do think that we're going to see these jump pretty aggressively. So that's something we're even thinking about in our aggressive models, is that maybe we can go really aggressive with some of these longer term bonds, and that could be a really good jump. But so far, it's just not happening. Just not seeing it. Dive into money flow. Money flow is still positive. We're just right at the 21, which is this line. If it's above that, then it's a very strong market. Above the 55, which is this blue, it's also positive. It's not bad. It's not good. It's just kind of we had a jump after the election. Let me actually jump back to that. The election jump, but then the last 5-6 trading days have actually just drifted down slightly, just barely. Not big moves. The intradays have just been chopping sideways. Nothing really to be concerned about. So going back to money flow is kind of popping out a little bit, but we had such a big spike from the election that it almost looked like a short covering rally. Like, a lot of people were betting that the market was going to fall after the results came out, but the opposite happened. So usually what happens is people were betting against, they've got to cover the shorts, which means they're buying the market, which pushes it higher and faster. That's how you get these really fast moves when they're unexpected. So now that is played out, we're kind of in this, okay, now what? Are we in a good place? Are we in a bad place? What's going to shift? Where do we want to be, and that sort of thing. So that's really where we're at, trying to figure out what's going to be positive going forward. Money flow again peaked right there after the election, and then it's kind of drift off. We're still positive. I think it's actually close to zero today. Not bad, not good. Lean's good. Nothing wrong, nothing bad going on here. After a sketchy part, as I showed earlier, the market kind of was drifting off, but not even really selling off as bad as these numbers were. But we are pretty positive right there. Sectors, again, we've got the defensives, are the weak ones, right? Real estate, utilities, healthcare. That's really, when things are bad, this is where you want to be, and those are not where you want to be. You want to be in the techs. Oddly, energy is over here. Financials are really good. Consumer discretionary, consumer staples, tech, industrials. So one of the things that I think that will shift is we've had a very positive time in tech, and I don't think that's going to change too much because tech is always a strong sector, no matter who's in power in our country. But what might be surprising is we might have things like financials and energy will probably do pretty well in theory. I want to see what policy plays out. Does that really affect it directly? What does oil prices do? Because that's a little bit, can be an effect as well, but I don't, I want to see how that goes. But as of right now, that's really the places that we're watching the most and see is this where we want to be going forward? And it may well be for the next couple of years. So that could be a positive. But yeah, we're still looking at defensives on the negative. We're looking at all the offensives on the positive. So it's hard to bet against a market that's looking like that. And then again, on the rotation, you can see the discretionary communications, which is like the Facebooks and stuff. Those are all up over there. Financials did a very quick reversal, right? They're just kind of all over the place. But then defensive, or utilities, defensive, basic materials, a lot of defenses are pushing down, but they may come out of this lagging box pretty good. If they all agree, I love to see them all agree and all push into this blue at the same time. Then you really see a good market move. What we just saw was more of a quick reaction to something happen rather than been a broad, okay, market's really good, it's going to run up. So I'm not negative in the market. I'm not really positive, kind of neutral. There's really not a lot of reason not to be invested at the moment, but it's not exciting. The excitement, I guess, is over. So we'll see what's there. And then finally, I want to jump on volatility. And this is really a measure of fear. You can see coming into the election, the fear was up here. Quickly on my lines here, this green line right there is at 16. When the VIX is over 16, when this reading is over 16, that means below 16, that means the expected move of the S&P is around 1% daily. Less than 1% moves going forward. And then we're back to that area, right? We're not expecting a big 2, 3, 4% daily moves. We're just slowly chopping around. But that's usually positive. Usually when we get these spikes above 16 or even 20, above 16 to 32, that's where you're expecting 2%, between 1 and 2% moves. And then over 30, 32, you're expecting really, really big moves when you get these big spikes, right? Something is really wrong. But also, that's also tends to be where bottoms happen. So if you see a spike up there, that may be a really good time. See right there that it might be the end of a washout and people giving up on the market. But so going back to here, we're back down in this around 14, I think 1402. That's not a scary number. I mean, the market grinds up when this number is below this 16 line. So we're back below there. If we spike above, then there might be a reason to start looking to back off, to hedge, to be careful. At the moment, there's just not. The only problem is the only places to be are the S&P and NASDAQ, as I showed you in the beginning. International emerging markets are kind of not great. Bonds are not helping. So you really have to be focused on those spots of the market to do okay right now. Even with volatility low, that's really more domestic related. I'm not sure what else is going on in the world right now that might need to be addressed. But for now, we're focused on the domestics, and that's where we're at. So far so good. I'm not really afraid, and I think going forward we should be in a good spot. Certainly going into the best 3 months of the year, which is November, December, January. So hopefully go well. That's what I'm looking forward to.